Welcome to Griffonomics. So imagine inventing a laptop that is, so secure it can literally defeat quantum computers.
Yeah, and so smart, it holds a 20 billion parameter AI brain right on its own hard drive.
Right. But then imagine that despite building this total technological marvel, your profit margins are just actively collapsing. So, for today's deep dive, we are looking at HP Inc. And, well, the brutal reality of what happens when digital innovation collides head-on with physical supply chain chaos.
Because that collision, that is the defining story of the tech hardware industry right now. Our mission today is to build out a granular strategic report and an investment roadmap on HP. We want to figure out how this massive company is trying to pivot from just a traditional transactional hardware vendor into this AI-powered service and subscription platform.
And doing all that while navigating some of the absolute worst macroeconomic headwinds we've seen in a decade.
Exactly. It is a perfect storm.
So to build this roadmap, we've got a towering stack of sources we are pulling from. We're looking at their latest SEC filings, so the 10K and 10Q, the recent Q1 2026 earnings call transcripts, plus analyst reports from Morgan Stanley and JP Morgan.
And we're also digging into the detailed press releases from CES and that recent HP Imagine 2026 event.
Right. And whether you are, an investor monitoring a portfolio or an IT professional managing a fleet of enterprise devices, or honestly just someone trying to figure out what laptop you should buy next, this deep dive matters to you.
Oh, totally. HP's current situation is basically a masterclass in corporate survival.
Let's start by defining what actually generates the bulk of their revenue right now, looking at that core growth engine.
Well, the core engine is definitely their personal systems segment. That's your desktops, notebooks, workstations, all that hardware. In the first quarter of fiscal 2026, personal systems accounted for roughly 70% of HP's total net revenue.
Wow, 70%.
Yeah, pulling in $10.25 billion in just 3 months. It's an absolutely massive footprint.
But, the fundamental flaw with relying on hardware is the transaction model itself. You buy a laptop, and the manufacturer doesn't see another dime from you for, what, 4 or 5 years?
Exactly. And HP totally recognized this vulnerability. That's why we are seeing such a dramatic pivot over in their printing segment.
Right, because hardware sales for printers are in this secular decline since society just prints way less paper now.
Right. But HP countered that decline by shifting to a highly lucrative recurring revenue model. They already have over 13 million subscribers locked into their ecosystem.
Wait, 13 million?
Yep. 13 million. Those are folks enrolled in programs like Instant Ink, Instant Paper, and, their newer comprehensive all-in plan.
Ah, the all-in plan.
Yeah, which actually bundles the physical printer, the ink or toner, and dedicated tech support into just one flat monthly subscription.
It's a brilliant pivot. It operates exactly like a traditional car dealership, where you buy a car and the dealer maybe never sees you again, transforming into this sort of transportation as a service membership club.
That's a great way to put it.
Yeah, you don't own the printer anymore. You're simply subscribing to the ability to print whenever you need to.
And that membership model just fundamentally alters the economics of the print business. By converting a sporadic purchase into predictable recurring revenue, they've completely insulated that division.
So what do those margins look like now?
Because of those subscriptions, their print operating margins are sitting at a stellar 18.3% right now. That is right near the top of management's long-term target range.
Okay, so they've stabilized the print side with subscriptions, but you can't exactly run a subscription model for a high-performance PC. If 70% of your revenue relies on hardware sales, you need a technological leap so huge that your perfectly fine laptop suddenly feels completely obsolete.
Enter the AI PC.
Right.
That is the strategic inflection point they are banking everything on. The AI PC Supercycle is rapidly taking over their entire portfolio. In Q1 2026, AI PCs already made up 35% of HP's total shipments.
Which is wild for how new the category is.
I know, and they are targeting 50% in just a couple of years, and a staggering 70% by fiscal 2028.
And the financial motivation there has to be the average selling price, right?
Exactly. HP anticipates a 5 to 10% ASP uplift on every single one of these machines.
The hardware specs driving that price bump are intense. Looking at the sources, they detail the new HP EliteBook X G2 series, which has an architecture capable of 85 NPU TOPS.
Yeah, 85 is massive.
And just to put that in perspective for you, the listener, an NPU is a neural processing unit. It's a chip designed specifically for the heavy math required by AI, and TOPS stands for trillions of operations per second.
Right.
So at 85 TOPS, you aren't just, blurring your background on a Zoom call anymore. You are running massive local language models that can summarize an hour-long meeting in real time, generate code, analyze spreadsheets, all without the laptop even breaking a sweat.
And they're pushing the physical boundaries, too, like with the HP EliteBoard G1A.
So the keyboard thing.
Yeah, it's the world's first full AI PC built entirely into a keyboard. You just plug the keyboard into a monitor, and boom, your entire computing ecosystem is right under your fingertips.
But, moving that kind of hardware volume requires an enterprise software ecosystem to back it up. I mean, people need a reason to use all that power.
Right, which brings us to early 2026. HP established this exploratory partnership with OpenAI to pilot something they're calling OpenAI Frontier.
Which is what, exactly?
It's a new enterprise platform aimed at building and managing scalable AI agents across an entire workforce. And it has built-in governance, security, and observability protocols.
Okay, wait, I have to push back on the strategy for a second. The prevailing narrative in tech right now is that the cloud handles AI.
Sure.
Like, when you use a chatbot, the complex thinking happens in a massive server farm in the desert somewhere, not on your device.
Yeah.
So why is HP pushing so aggressively for local AI processing on the physical laptop? Are they just, trying to justify selling more expensive NPU chips?
Well, I mean, that's a valid skepticism, but it ignores the very real friction points of enterprise computing right now. Organizations are actively retreating from cloud-only AI for three main reasons: latency, cost, and privacy.
Okay, latency makes sense.
Right. If your AI has to send data to the cloud, wait for a server to process it, and send it back, there's an inherent delay. If you're doing real-time video translation or, say, active cybersecurity threat detection, that lag is totally unacceptable.
Yeah, and the cost variable is huge, too. I mean, paying for API calls to a cloud AI might just be fractions of a cent per query, but...
Multiply that by 50,000 employees.
Exactly. 50,000 employees running hundreds of queries a day. Suddenly, the enterprise is bleeding millions of dollars in cloud fees.
Yeah.
So offloading that compute power to the local laptop saves an absolute fortune.
Exactly. But privacy is the absolute bottleneck here.
Oh, for sure. I cannot imagine a hospital IT director being comfortable uploading thousands of patient medical records to some public cloud just to let doctors use a diagnostic chatbot. The liability is just insane.
Right, so running the large language model locally, directly at the edge, means that sensitive data never leaves the physical laptop. It's inherently faster, vastly cheaper, and fundamentally more secure.
Which perfectly sets up that new software layer HP recently announced, the HPIQ.
Yeah, HPIQ is their new connected workplace intelligence layer. The critical feature is that it operates primarily on a secure, local 20 billion parameter AI model.
20 billion parameters right on the hard drive.
Yep, because it lives directly on the device, it integrates right into the operating system. It powers things like AskIQ for contextual guidance, and it has a meeting agent that actively takes notes and captures action items during video call without making you switch windows.
But if an enterprise is going to store incredibly sensitive data and a massive 20 billion parameter model locally on a device, the physical security of that device has to be basically impenetrable.
Oh, absolutely. As the data gets more valuable, the vault holding it has to get stronger.
And HP is attacking that on multiple fronts. I mean, looking broadly at their ecosystem, they just launched the world's first quantum-resistant laser jet printers.
Which just sounds like science fiction, honestly.
It really does. But experts predict a 34% likelihood that within a decade, quantum computers will have the power to break current encryption standards. And printers are networked computers, which are notoriously used as weak points for corporate hacks. So HP is mathematically future-proofing them right now.
That's wild.
Yeah.
But the more immediate physical security innovation they announced is HP TPM Guard. And the context behind this from the CES sources is just fascinating.
Yeah, the BitLocker vulnerability.
Exactly. It highlights a terrifying flaw in how standard Windows laptops encrypt data. You literally have billions of dollars in corporate R&D being defeated by parts you can buy with a $20 bill from a hobby store.
Wait, 20 bucks?
Yeah. BitLocker is designed to scramble your hard drive, so if your laptop gets stolen, the thief can't read your files, right? But security researchers showed off a TPM bus attack.
How does that work?
So a bad actor with physical access to your stolen laptop uses a cheap hardware tool to intercept the electrical signals traveling between the computer's CPU and the TPM, the Trusted Platform Module, which holds the encryption keys.
Wow.
Yeah, they can bypass the entire BitLocker encryption in under a minute.
A 60-second bypass with a cheap hobby kit entirely defeats the purpose of enterprise encryption. So what is HP's fix?
To combat this, they developed TPM Guard. It's a hardware-enforced solution that cryptographically binds the TPM chip directly to the CPU.
Oh, so it physically links them.
Exactly. It creates a proprietary encrypted link that stops these probing attacks. If someone tries to intercept the signal or tamper with the motherboard, the chip detects the intrusion and just renders itself completely inoperable. It permanently locks the data.
Okay, let me just summarize this value proposition for you, the listener, to make sure the narrative tracks here.
Go for it.
So, HPIQ allows you to process highly sensitive company documents locally using a 20 billion parameter model, meaning proprietary data never touches a public cloud. And then TPM Guard ensures that even if someone steals your physical laptop from an airport lounge and tries a $20 hardware bypass, they absolutely cannot extract those documents.
That is a pitch. Unprecedented local AI capability locked inside a mathematically and physically impenetrable vault.
But packing quantum-level security and 85 TOPS of AI processing power into a thin aluminum chassis requires some incredibly sophisticated internal components. And right now, the global supply chain for those components is a total nightmare.
Right, and this brings us to the macroeconomic reality checking HP's ambition. They are currently trapped in what industry analysts are calling a severe memory supercycle.
We really need to define the mechanics of that supercycle because it is actively crushing their bottom line.
So there's unprecedented inflation occurring in the pricing for DRAM and NAND memory chips. DRAM is your system's short-term working memory, and NAND is your long-term storage, your solid-state drive.
And the prices are just spiking.
Insanely so. Right now, the fabrication plants that build these chips are strictly limiting their output to drive up market prices. And simultaneously, they are retooling their lines to prioritize massive, highly profitable server chips for data centers.
Because everyone wants to build out cloud AI.
Exactly. That leaves PC manufacturers scrambling for a heavily constrained supply. As a result, memory costs spiked roughly 100% sequentially in just the second quarter of 2026.
100% jump in one quarter. So how does a component price spike like that alter the economics of building a single laptop?
You have to look at the bill of materials, the BOM. Historically, memory and storage made up about 15 to 18% of the total cost to build a PC. But for fiscal 2026, because of this supercycle, memory alone is ballooning to approximately 35% of the total cost of the machine.
35%, that's brutal.
It gets worse. There are also global CPU supply shortages from both Intel and AMD right now, resulting in 8 to 12-week wait times just to acquire the processors.
Okay, so when your build costs skyrocket like that, you inevitably have to raise the retail price of the system, right? But raising prices right now is disastrous because the total addressable market, the overall pool of buyers, is contracting.
Yeah, the demand just isn't there right now.
Right. The sources note HP and analysts expect the total PC unit TAM to shrink by double digits in calendar year 2026. It's a pandemic-era purchasing hangover combined with general economic inflation reducing consumer discretionary income.
Which creates an impossible mathematical equation for them. If memory makes up 35% of your build cost, and you are forced to raise prices in a market that is actively shrinking by double digits, you simply cannot maintain your profit margins.
So what did management say?
Management explicitly warned Wall Street that their personal systems operating margins will fall below their 5 to 7% long-term target range for the rest of the year.
And as if component inflation wasn't enough, they are also exposed to immense geopolitical friction. HP operates this sprawling global supply chain, so they're highly vulnerable to tariff volatility.
Extremely vulnerable.
The sources indicate the Supreme Court recently struck down the IEPA and fentanyl tariffs. IEPA is the International Emergency Economic Powers Act, which presidents use to regulate commerce during emergencies. Now, strictly looking at the balance sheet, the removal of those specific tariffs provided a slight net benefit to HP's operational costs.
However, the administration immediately countered that Supreme Court ruling by implementing retaliatory 15% across-the-board tariffs under Section 301.
Right, and to be clear to you, the listener, we are not taking a political stance on whether these tariffs represent sound trade policy. We're just reporting what the sources say.
Yeah, and the financial reality reported in the material is that these rapid, unpredictable policy shifts create massive cost forecasting issues for a hardware manufacturer operating on thin margins.
The unpredictability is the actual threat here. It's like trying to rebuild the engine of a commercial airplane while it's in mid-flight during severe turbulence. You can't just pause global operations to figure out the new rules of international trade. It's a giant geopolitical chessboard.
Exactly. And to survive that turbulence, HP is heavily investing in supply chain de-risking. To build operational resilience, they've proactively shifted over 30% of their manufacturing out of China, relocating those vital facilities to emerging hubs in Southeast Asia and Mexico.
So when you synthesize all of this, the memory supercycle, the TAM contraction, the geopolitical tariff warfare, you can see exactly how these forces dictate HP's Q1 financial results and their outlook for the rest of 2026.
Definitely. Reviewing the Q1 numbers under their interim CEO, Bruce Broussard, the surface-level performance was actually surprisingly resilient. Net revenue hit $14.4 billion, which is a 6.9% year-over-year increase, and they delivered an EPS beat, hitting 81 cents.
Strong top-line revenue is great, but the forward guidance is where the macroeconomic pain becomes really visible.
Precisely. Because of that memory margin compression and the double-digit contraction in the PC market, management had to revise their outlook downward. They are now officially projecting that their full-year non-GAAP earnings per share will land at the lower end of their previously stated $2.90 to $3.20 range.
And the broader market generally punishes that kind of margin compression and uncertainty.
True. But despite that margin pain, the financial documents make it clear that HP maintains a highly disciplined, shareholder-friendly capital allocation framework. They are still targeting a 100% free cash flow return to investors over time.
Which is a critical point for long-term investors. Even navigating this perfect storm, HP expects to generate strong free cash flow between $2.8 billion and $3.0 billion for fiscal 2026.
Yeah, and they currently have a massive $8.1 billion remaining in share repurchase authorization, keeping their gross leverage highly disciplined right around their 2.0x target. The company is fundamentally solvent. They're just getting squeezed on the cost of goods sold.
And to combat that squeeze, they're implementing what they call the Fiscal 2026 plan. This is where AI actually comes back to save the day internally.
Oh, yeah. They are targeting $1 billion in gross annualized run rate savings by fiscal 2028. And they're doing it by deploying AI digital teammates to automate their own supply chains.
I mean, if you are selling AI as an enterprise productivity multiplier, you have to eat your own cooking, right?
Exactly. By automating order entry, product returns, and channel partner support, they are actively stripping structural costs out of the business to weather the commodity inflation.
So what's the consensus from Wall Street?
Evaluating the analyst reports from Morgan Stanley and JP Morgan, Wall Street's consensus is deeply cautious. The stock is broadly rated as neutral or placed on watch lists.
Because of the margins.
Right. Analysts fully acknowledge that the AI PC adoption story is accelerating, the OpenAI Frontier partnership is structurally sound, and that billion-dollar cost savings plan is robust. But the extreme memory inflation keeping those personal systems margins suppressed just creates way too much near-term risk.
There's simply limited visibility into when DRAM and NAND costs will actually normalize.
Exactly.
So for you, the listener, what is the ultimate takeaway here? I mean, HP's current trajectory is a perfect microcosm of the broader tech hardware industry today. You can engineer the most groundbreaking, futuristic AI like the OpenAI partnerships or the 20 billion parameter local models like HPQ.
Yeah.
And you can literally invent the coolest hardware on the market, like a full AI PC hidden inside a keyboard. But if the raw materials, the silicon memory chips, cost too much, and if geopolitical tariffs constantly upend your supply chain, your profit margins will still collapse.
The physical world still fiercely dictates the digital world's success.
It really does.
But, observing this transition raises an important, almost philosophical question to leave you with.
What's that?
Well, as HP successfully shifts its massive enterprise user base toward these local on-device AI models, if millions of employees are running HPIQ securely on their own desks, rather than processing data in the cloud, do hardware manufacturers eventually capture more power over enterprise workflows and data security than the cloud hyperscalers do today?
Oh, wow.
Right. If your laptop is its own secure, self-contained AI server, does the multi-billion-dollar cloud infrastructure suddenly become secondary? It's just something to consider the next time you open a sleek, cold piece of aluminum.
Risk defined, portfolio protected.